Hey everybody, back with another dividend analysis, and today we're going to be looking at Big Lots Inc., or BIG, or simply Big. Wanted to take a peek at them because they have had a very large drop over the past few months, as well as having earnings last week that went very poorly. If we look at the 6-month chart here, we can see that they used to be trading around 70 bucks. They are down to almost $50 a share. Quite the discount in that regard, and over the last few days they have dropped from about $58 down to $51. Again, very big drops. Earnings didn't go so well, so let's see if it's not on sale. Let's see if there's not something we can do here for a dividend stock. Going back to the dividend history, we can start by looking at the current yield. It's actually about 2.3%, which isn't terrible. It's doing better than the wide market, not by much, but it's still better than about 1.5 or 2% that you're going to get from the S&P, but still nothing to write home about. If we take a peek at the history, we can see that about 7 years ago, 2014, we're getting 17 cents a share, whereas currently we're getting about 30 cents a share. So we've almost doubled in our dividend over the last 7 years. However, it should be noted that since 2018, we have not gotten a dividend raise. So really all of that growth took place over about 3 years, whereas now we haven't gotten any increases. This could be for a lot of reasons. The company may be doing other things like paying down debt, buying back shares, other things that are making it so they can't increase that dividend or they don't want to increase that dividend. Just be aware of that if you're looking at dividend appreciation. There's not going to be a ton here. We don't have any cuts or anything like that, but no increases, so just be aware. Next, we can go take a peek at the numbers, and we can see that currently, or I should say over the last year, they paid out about $47 million in dividends, and we can see if that's supported by their cash flow and their income. Going to the free cash flow, we can do a quick calculation of $319 million in free cash flow. That gives us a ratio of payout of 15%, very low, well under our 50% ideal range. They could pay this dividend out about 6 times over with their current free cash flow and still have a bit of money left over. One thing to note, however, is that their cash flow over the past decade has been very, very spotty, very up and down. We can see going from the 200 millions down to the 100s, down to the negatives, back up to 200, back up now to 300 million. So it's not stable is a good way to put it. Be careful. You really want to see this start to normalize in some way. We have 210 here. Maybe if we stick at that 210 to 319, we're not dropping back down in the negatives or into the double-digit millions. That would be something you'd want to see here. So if you're in this, if you're looking at this, look at the next couple years, see if that starts to normalize. Next, we can take a peek over at our income, and we can see that our net income last year was $674 million, giving us a payout ratio of just 7%. Very, very low. They could afford to pay that dividend 10 times, 12 times over, and still have a bit of money left over. However, when looking at last year, this is a bit of an anomaly. As we can see, over the previous 10 years, they did not break $200 million until 2020. And 2020 being higher makes sense due to Big Lots being one of those places that was able to stay open because they do sell food. So I would take these two numbers. I would almost strike these out because they aren't likely to repeat. The 276 might be able to repeat, but we're not going to see 700 million year over year. It's just not sustainable. So when you're looking at that income, a payout ratio that's going to make more sense here is probably that free cash flow number. Maybe we're at 7% of income. Something like 20 to 25% of income is probably a lot more reasonable. Again, not a bad payout ratio at all, well below our 50% ideal range, but just make sure that you realize that last year is something that's very unlikely to happen year over year. So how is Big Lots making this money? What do they do? How are they creating this cash flow? Big Lots is a discount retailer, a closeout retailer, really. A lot of what they do is going to be buying out items from producers or other retailers that they can't get rid of at a discounted price. Say they're going to buy it from them at 30% and then sell it for a slight markup. That's how they're going to make their money. It's a very good business model. It works for a lot of companies. It works for a lot of privately held businesses. It's just a good business model because it gives a lot of room for them to be able to control their prices, control their margins, control how they're going to make their money. Some issues with it should be very obvious. It is a retailer, so when people don't have money, they aren't going to be able to spend money, and their margins, their income, their revenue are going to take a hit. However, because it is a closeout retailer and its prices are going to be a lot lower than a lot of its competitors, sometimes even Walmart or Target, they're going to have lower prices. If there is some kind of economic downturn where people are hard strapped for cash, places like Big Lots might not suffer as much because they're selling things at such a discount. So just keep that in mind. When you're looking at this, you really want to look at how it's doing compared to its competitors, how the other retailers are doing, the general retail numbers, how it's fitting in there, in addition to its quarterly and annual reports. Those are all things you're going to want to look at if you're thinking about investing in this particular company. So is this something you want to be looking at? Who is this dividend quote-unquote company for? It's really hard to say. The last 2 years have made things very complicated. The numbers being so different from what they usually were just makes it really hard to evaluate this company. If you're an appreciation investor, there's really not much here. If we go back and look at that history, if there is some kind of dividend increase, it's probably going to be small and it's probably not going to be continuous. So if you're looking for appreciation, there's plenty of companies that are raising their dividend every year or every couple years. This is probably something you're not going to care about that much. If you're looking for yield, 2.3% isn't great by any means. However, it is decent for retailers. You're doing better than your Walmarts or your Targets, who are both well below 2% here. But again, the last couple years being so strange make one wonder whether or not they're going to be keeping those numbers up. So if you are looking for yield and you're looking for a retail spot to put into your portfolio, this might be something to look at. I would caution you to do a lot of research, to look at trends, to see how it fits in the broader retail environment, to see how it fits in the consumer staples and the consumer discretionary environment. Just really see where this is and make sure you're not getting into something you don't quite understand. I hope that helps, and thanks for watching.